You must have higher time frame context when looking to take a trade in the market, and here's why. If you gain value from this video, make sure to follow me so you don't miss any future trading and life tips. So for example, here's my personal perfect entry model, but we have no higher time frame context. And let's just say this is the 1 minute time frame. We swept sell side liquidity and followed that by a change in the state to the upside. We then retrace back to a bullish fair value gap for an entry to target buy side liquidity. With no higher time frame context, there is no way for me to know if the market truly wants to target buy side liquidity at this point, or if this is just a higher time frame retrace to then continue lower and stop me out. So here's a reason why I would not take this setup because of higher time frame context. Shown in blue, let's say that is the 15-minute time frame. We swept buy side liquidity and followed that by confirming a 15-minute change in the state to the downside. So, based on the 15-minute time frame, I don't expect to target buy-side liquidity on this 1-minute long setup. What I would expect is just a 15-minute retrace back up to, let's say, the 15-minute order block to then get a strong move to the downside. So now let's go over a reason why I would take this 1-minute long setup. Let's say the 15-minute time frame shown in blue again swept sell-side liquidity and followed that with a 15-minute change in the state to the upside. We then retraced back down to 15-minute equilibrium, and at 15-minute equilibrium, we scaled in to see this 1-minute long setup shown in black. Based on the 15-minute time frame, I do expect us to move higher, and now we are getting an internal 1-minute long setup. This is now a high-quality trade because we have higher time frame context as to why we should move higher. At this point, I can now expect the market to target buy-side liquidity. So a simple way to go about making sure you have high time frame context is based on the higher time frames before you, let's say, enter a long position. You should be able to answer these two questions. Why should the market go higher? And why should the market not go lower? If you can't answer those questions, then you don't have the proper high time frame context to take that position.